Howdy, everybody. Welcome to Liberty Call. Today is Monday, October 21st, 2024. Hope you're having a fantastical day out there in the interwebs. It's actually pretty nice here this afternoon here in Colorado. It was raining all morning, but the sun decided to grace us with its presence. Very, very nice. All right. Well, hope you all had a great weekend. Not me. Texans lost. FSU lost. U of H lost. All my teams did not do well this weekend. So, well, the Texans played pretty well. They just lost by a field goal at the last second. So, anyways, before we jump into today's numbers, if you, yes, you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All righty, let's get into the markets for today. Dow Jones was down 0.8%, 344 points, closed at 42,931. SP 500 down 0.18%, 10 points, closed at 58.53. NASDAQ up 0.28%. 51 points, closed at 18,541. The VIX was up 1.89% today. It's at 1837. Canada down 0.4, Brazil down 0.11, and Mexico also down 0.44. I'm sorry, 0.4. In Europe, Germany was down 1%, the UK down 0.48, France down 1.01%, the Netherlands down 0.56, Spain down 0.71, same with Italy, also 0.71, Switzerland down 0.59, and Portugal down 0.67. Russian exchanges both green, MOEX up 0.54, RTSI up 0.88. And the Asian markets, the Nikkei was up 0.11%, Australia up 0.74, New Zealand up 0.88. In China, the Shanghai was up 0.2, the Shenzhen component up 1.09, China A50 down 0.39, DJ Shanghai up 0.46, Hang Seng down 1.57, and the Taiwan weighted up 0.24%. All right, good stuff. Let's get into the weekly economic update and see what's been going on there. Stocks posted modest gains last week with quarterly earnings season in full swing and the election on the horizon. 2 weeks and a day away. What do you think is going to happen in 2 weeks? Let's say 2 weeks from this Wednesday. Do you think it's going to be full-blown civil war or just people crying and moaning? Somewhere in between, I think. Let's see. Last week, the SP 500 increased by 0.85%, while the NASDAQ rose 0.8%. The Dow Jones Industrial Average advanced 0.96%, and overseas markets fell 0.31%. 6 in a row, stocks bolted out of the gate as the week began. The SP 500 and the Dow Jones Industrial Average hit record highs, with the Dow crossing 43,000 for the first time. Midweek, news of stronger than expected retail sales report contributed to overall market momentum. Retail sales rose a seasonally adjusted 0.4% in September, topping economists' forecasts. As the week wrapped up, the technology sector helped fuel a rally that pushed the SP 500 and NASDAQ to another record high. It was the sixth straight week of gains for the S&P 500, NASDAQ, and Dow Industrials. All right. Insights from corporate reports. There were many market forces pushing each other around last week. Corporate earnings reports drove much of the market action. Some of the most extensive financial stocks surprised on the upside, supporting a narrative that the economy remains strong. It does, sure. At the same time, a corporate report from one of the world's largest chip manufacturing contractors revealed continued strong global demand for AI microchips. However, increasing investor anxiety was a constant undertow in trading as the November election drew nearer. Economic data coming out this week. Today on Monday, Fed officials Lori Logan, Neil Kashkari, and Jeffrey Schmidt were speaking. Tuesday, Fed official Patrick Harker speaks. Wednesday is existing home sales, Beige Book, and Fed officials Michelle Bowman and Thomas Barkin are speaking. Thursday is new home sales and weekly jobless claims, and Fed official Beth Hammock speaks. And Friday is durable goods and consumer sentiment. Companies reporting earnings this week. Tuesday is GE Aerospace, Philip Morris, Verizon, Texas Instruments, RTX Corporation, and Lockheed Martin, and Fiserv. Wednesday is Tesla, the Coca-Cola Company, T-Mobile, Thermo Fisher Scientific, International Business Systems, y'all know them as IBM, ServiceNow, AT&T, Boston Scientific Corporation, and Boeing. Thursday is Amazon, S&P Global, Union Pacific, and UPS. And that is the week. All right. Well, let's hop into the market recap for today. S&P 500 slips as Treasury yields jump. Tech earnings are eyed. The S&P 500 closed lower on Monday as rising Treasury yields weighed on the broader market, reflecting investor caution following remarks from Federal Reserve officials advocating for more gradual pace of rate cuts. The two-year Treasury yield rose by 7 basis points to 4.025%, while the 10-year yield climbed above 4%. Meanwhile, Minneapolis Fed President Neel Kashkari emphasized that he foresees only modest cuts over the coming quarters. Despite the broader market decline, NVIDIA led a surge in tech stocks, gaining 4% ahead of key earnings reports from the sector. Major companies like Tesla, Texas Instruments, Western Digital, Lam Research, and IBM are set to release their earnings this week, with significant attention on Tesla's report after a lukewarm reception of its robotaxi unveiling. Meanwhile, key defense firms such as Lockheed Martin, Northrop Grumman, and General Dynamics are also scheduled to announce results. In corporate news, Boeing rose over 4% after proposing a new contract to its machinist union, while Kenvue saw a 5% increase as activist investor Starboard Value took a stake in the company. Spirit Airlines soared 52% following a deal with U.S. Bank National Association regarding its credit card processing agreement. It's expected to be a quieter week for the economic data, with reports on housing, durable goods orders, consumer sentiment, and jobless claims anticipated. The Federal Reserve's Beige Book will provide insights into the economy across its 12 districts, and several regional Fed officials will offer remarks throughout the week. All right, some good stuff there. Next up, our friends over at First Trust, Mr. Brian Westbury, his Monday morning outlook. GDP growth is still solid. So let's see what he had to say. Oops, there we go. The U.S. economy is not quite in a recession yet, despite tight monetary policy and higher interest rates. With third quarter GDP set to be reported next Wednesday, the economy is projected to have grown at a 3% annual rate, primarily driven by consumer spending. Government budget deficits, particularly the $1.832 trillion deficit in fiscal year 2024, 6.4% of GDP, continue to provide income support, which may have masked the effects of tighter monetary policy. Consumer spending is estimated to have grown by 3.5%, contributing 2.4 percentage points to GDP growth. Business investment likely expanded by 1.7%, adding 0.2 points, with gains in intellectual property offset by slight declines in commercial construction. However, residential construction contracted by an estimated 5%, subtracting 0.2 points from GDP growth due to higher mortgage rates and local regulatory hurdles. Government spending on goods and services rose at a 1.8% rate, contributing 0.3 points to GDP growth. A slight reduction in the trade deficit is expected to add 0.2 points, while faster inventory accumulation will likely add 0.1 point. The anticipated 3% growth rate suggests that while the U.S. economy has not yet entered a recession, it remains vulnerable, especially as the effects of higher interest rates and government deficits play out. Nonetheless, high-tech innovation and government spending have helped keep the economy afloat for now. All right. Let's get to our last article here from Zero Hedge, the $100 trillion global debt bomb and financial shock risk. This was authored by Mr. Daniel Cal. So let's see what he had to say. It's not good news just based on the headline. In a recent report, the IMF warned of an impending fiscal crisis, stating that global debt is projected to reach $100 trillion in 2024, with U.S. debt to GDP expected to soar to 198% by 2050. Well, that's still a ways off. The G7 nations could see public debt rise to 188%, driven largely by excessive spending in the U.S. and China. Despite the IMF's calls for governments to reduce debt and rebuild financial buffers for future shocks, many governments continue to increase spending, disregarding fiscal responsibility. Yeah, they act like drunken sailors at a all-you-can-drink night. The IMF's advice, particularly its 2020 message urging governments to spend whatever it takes to weather the COVID-19 crisis, has contributed to the current high debt levels. Governments have adopted increased spending measures, but have neglected the recommendation to maintain fiscal discipline and oversight. The U.S. is one of the fastest growing debt burdens, with a projected annual increase in public to debt GDP of nearly 3 percentage points over the next 5 years, despite no expected recession. Yeah, right. Governments, particularly in the Eurozone, have used revised GDP figures to justify more spending, debt, and taxation. Meanwhile, central banks' loose monetary policies have further fueled government spending. This approach threatens global financial stability, with the middle class bearing the brunt of the burden through lower wages and weakening purchasing power. The IMF cautions that the combination of high debt, complacency, and potential economic shocks could trigger a global financial crisis. Unfortunately, governments are unlikely to heed warnings and may continue expanding their role in the economy during future crises. Yeah, no one has talked about how to, they never talk about firing federal employees. I mean, that'd be a good best possible solution would be just lay off the federal workforce. They don't need all these benefits and everything. I mean, they can go get a real job like the rest of us. All right. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can go get all your financial planning needs addressed. So feel free to give me a call. All right. Well, hope everyone has a wonderful evening, and I shall talk to all y'all again next time. Adios.